Welcome everyone to Vested Interest. This is Shane, Sunday, October 17th. If you're new to the channel, I've set up a portfolio of dividend growth stocks, and here we will be as transparent as possible, documenting all stock purchases, stock sales, and monitor the portfolio, and most importantly, the dividend returns created by the portfolio. Investments will be made at a minimum of twice a month, on or about each pay period. In addition, from time to time, I'll cover a topic I'm researching or find interesting, and hopefully you find it interesting as well. Comments, questions, and discussions are welcome in the comment section below, but please keep them cordial and within the guidelines set out by YouTube. If at any time you find the information presented here of value, please hit the like button, subscribe to the channel, and make sure to hit the notification bell so you are updated when any new content is posted. In this video, I'd like to discuss a topic I don't hear or see discussed much on YouTube. I'd like to discuss market and economic cycles and portfolio asset allocation. Now let's get started. First off, what is an economic cycle? Per freedictionary.com, an economic cycle is a period during which a country's economy moves from strength to weakness and back to strength. This pattern repeats itself regularly, though not on a fixed schedule. The length of the cycle isn't predictable and may be measured in months or in years. The cycle is driven by many forces, including inflation, the money supply, domestic and international policies, or international politics, and national and natural events. In developed countries, the central bank uses its power to influence interest rates and the money supply to prevent dramatic peaks and deep troughs, smoothing the cycle's highs and lows. We call that group the central bank's actually the Fed. That's what we call the Fed. Our central bank is the Fed. This up and down pattern influences all aspects of economic life, including the financial markets. Certain investments or categories of investment that thrive in one phase of the cycle may lose value in another. As a result, in evaluating an investment, you may want to look at how it has fared through a full economic cycle. And that really is the topic. How do different investments fare in different economic cycles during different times? What's good during a peak? What's good during a trough? What's good as the market climbs? What's good as the market declines? Here's a graphic representation of what that means. Let's review. So as you can see, looking at this chart that kind of goes over the economic cycle, you'll see times of recession, which is the decline, right? And it hits the bottom, and then you'll see recovery again, back to the peak, then recession, which is down to the bottom, which is called the trough, and then back recovery to the peak again. But notice the blue line, the growth trend. The growth trend is continually up. As a matter of fact, if you look at where the stock market was on the day you were born to now, you'll most likely see that growth trend, right? It'll be significantly higher now than it was at the day you were born. To me, that is the perfect reason to be an investor who uses dollar cost averaging, right? I might buy at a peak as it drops through a recession, hits the trough, and then through recovery back to the next peak. And if I'm buying at all those points, peak, recession, trough, recovery, peak, I'm going to hit pretty close to that blue growth trend, right? So over time, if I just continue to invest in my investments, regardless of what those investments are, I'm going to pretty much follow that upward growth trend, which is what we all want. That's what we want. We want to see not only our portfolios grow, but also the dividends that we're getting from that portfolio, if that's your chosen method of investing, grow as well. Next, let's look at the market cycle. And the first question, what is the market cycle? And it's real similar to the economic cycle. Well, here, a market cycle is the movement from a period of increasing prices and strong performance, or bull market, through a period of weak performance and falling prices, or a bear market. So the bull market is that growth, upward trend. Your bear market is that downward trend into a recession, or even the bottom of a recession if you flow sideways through a recession for a while. Cycles recur periodically, though not on predictable schedule. The length of each cycle and each phase within it varies from several months to several years. A good example of that would be the 2008 crash was over several years. So you had the crash really started in 2008, downward trend through 2009, 2010, and really didn't start an upward trend until 2011. But then most recently, last year, we had what they called the flash crash caused by COVID. That only lasted, a few months. A downward trend for a few months, floated sideways for a month or so, and then started back on the recovery upward trend. The top of a cycle is called a peak and the bottom a trough. We just saw that on the previous slide. A market cycle generally runs ahead of the concurrent economic cycle. Now this is also important. For example, and you're going to see it on the next slide. For example, investors begin to sell stocks because they anticipate a recession or turn bullish in the early stages of a recovery. However, not all sectors of a market operate on the same schedule. For example, some stocks, such as utilities, have historically prospered in the downward phase of the stock market when most other stocks have underperformed. Similarly, the stock market tends to operate on a different cycle than the bond or commodities market. These overlapping but distinct cycles are the basis of the investment strategy known as asset allocation. Now this is important. Asset allocation comes into play based on the market cycles, because then you can shift what you're investing in based on what market you're in. Now you really have to understand what market you're in for this to work well. And there are certain investments that are going to basically run, regardless of what market you're in, they're going to run pretty well in an upward trend. And we'll talk about that a little bit more here in a minute. But next, let's look at another graphic that shows the market and the economic trends. So as you'll see here in this graphic, the market versus the economy cycles and sector rotation. The red is your market cycle and the blue is your economic cycle. And you'll notice how your economic cycle tends to follow or lead your market cycle, right? And really your economy is you and I spending money. That's the majority of the economy. It's how do we, so you'll hear terms like consumer confidence, right? That's really how you and I feel about the economy. Are we confident that the economy is doing well? Typically in those we'll spend more money, and those tend to lead to, if we're in a recession, recovery, or if we're in a recovery phase already, it tends to lead to continued spending. So another thing I like about this particular graphic here, you'll see finance, technology, and cyclicals tend to do better at a market bottom. That may be what you want to look at whenever you're in a market bottom. During a bull market, so as you're running up, which I would say we've been in a bull market for quite a while, technology, industrials, and basic materials tend to do well. When you're towards the top, basic materials, energy, and staples tend to do well. And then as you hit the top and kind of head down towards another recession, energy, staples, and healthcare tend to do well. And then again, when you're in a late bear market, healthcare, utilities, and finance tend to do well. So a couple that personally I think do well in any market are staples. Staples tend to do well. Consumer staples, these are things people are going to buy regardless of what the market is. So you'll see them in a bear market, you'll see them in a bull market. They're pretty well, pretty good sectors to be in to ride out any market. So this is actually my a quick breakdown of my portfolio and how it's broken up by sector. You'll see I've got 6.76% communications, consumer discretionary is 2.61%, consumer staples currently is 14.6%. Again, you'll notice that's one of my larger positions, because I believe that consumer staples tend to do well in any market, so I don't mind having that be a heavier weighted position. Energy is 11.26. Again, I don't mind that being a little heavier weighted, because I don't think there's going to be a time where we don't need energy. Everyone, regardless of where you live, that's one that's kind of cyclical throughout the year. You'll notice energy costs in the north tend to go up in the wintertime as it gets colder. People are turning on their furnaces. And just the opposite in the south, they tend to go up in the summertime as people turn on their air conditioning. So you can even play those cycles on a yearly basis based on the changing weather patterns, right? So then you've got financials at 7.53%, healthcare at 12.35%, industrials at 14.37%. That's a little heavier weighted right now. I've been actively investing in a couple companies in that sector. Technology at 7.98%. Some people really like this sector right now because we're in a bull market, and technology tends to do well in a bull market. Materials at 3.66, utilities at 9.63, REITs and real estate at 9.20, and I don't currently have any ETFs. To be honest with you, I may invest in some ETFs in the future, but I think you can look at any ETF really yourself, and you can invest in the company if you like ETFs. You can look at those ETFs and invest in the companies those ETFs invest in yourself, and then make up your own ETF and not pay any fees and do it all yourself. Now, the percentages of my portfolio will change over time, and some people like to even out the allocations more evenly than I do. You know, you might take these sectors and just do a division by the 12, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 sectors, 12 if you've got ETFs, and even that out and say you want to equal weight in each one. I don't do that. Like I said, I think some sectors are better than others, especially consumer staples, so I don't mind that being heavier weighted personally. What you do with your portfolio and how you allocate it, that's completely up to you. But really, what does that look like based on the market? Currently, like I said, consumer staples, I'm continually adding to consumer staples. I'm continually adding to some other sectors. I think we're at the top, personally. That's where I think we're at. And I think some other sectors like energy and utilities are going to do well in the future, because as we hit the top and start to go down into another recession, these will be the areas that I look to, and probably industrials as well, but definitely energy and utilities as well as consumer staples that I will continue to invest in regardless of what the market is, whether we're at the peak like we are now, in my opinion, or whether we enter into a recession. Now, what you do and how you invest, again, that's going to be up to you. But I'd like to know, where do you think we are currently? Do you think we're at the top? Do you think we're still climbing to the top? Do you think we've peaked and we're headed lower? How are you allocating your investments in your portfolio? Do you look at the market and adjust based on market conditions? Let me know in the comment section below. I'd really like to know your opinion. And also, I believe this topic, if you're interested, you should probably do a more deep dive, a more informed deep dive than what I've given you here. This is just kind of an overview of the topic, and then you can look back and see over time. That would be my suggestion. You go out through historical time and see when we were in a recession, see when we were obviously in a growth phase, and then see what the markets did. What did the sectors do in those phases? Were they growing, or were they in decline? Were they stagnant? And then that'll give you an idea of what you may want to do in the future with your asset allocation. But I do believe that looking at the market conditions, where we're at in the market, and understanding that will help you be a more informed investor. So keep that in mind. Now, just a reminder, I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational entertainment purposes. Investing involves risk. You can lose money and should never invest any amount you are not comfortable losing. Always do your own research and invest based on your situation, circumstances, and selected criteria, or seek the advice and counsel of a certified financial advisor. If you found any value in this content, please hit the thumbs up, ring the notification bell, subscribe to the channel. I'll stop back next time where we will cover the most recent additions to the portfolio. Hope you have a great Sunday. This is Shane signing out. And remember, if you want to secure your financial future today is the day to take a vested interest. Thanks for stopping by and take care. We'll see you in the next one.